Welcome to Iron Financial. This is the place where we help you forge a stronger portfolio, cutting right through all the market weakness and the noise. Today, we are putting SBC Medical directly under the microscope. You know, their latest earnings report is, well, it's a puzzle. It's a paradox wrapped in an enigma. On the one hand, you see this massive, glaring crack in their revenue, but on the other, somehow they're forging higher profits. Now, this is exactly the kind of report that traps unsuspecting investors. It's the kind of thing that separates the pros from the amateurs. So our mission today is to drill down way past the headlines, to check the structural integrity of this company, and to figure out once and for all if this is a solid investment or just a hollow shell that's waiting to crumble. Let's get to work. Whoa. Hold on a second. Let me get this straight. You're telling me their total revenue cratered by 15%. I mean, sales didn't just dip, they fell off a cliff. And yet, somehow, their net income, the actual profit they take home, went up by 9%. How? Seriously, can you explain to me how a company sells less of its product or service and somehow makes more money? My gut, my experience, everything is screaming that this is a classic case of financial engineering. This is the kind of accounting wizardry that gets companies into a world of trouble. We absolutely have to figure out if there's any real substance here or if this is all just smoke and mirrors designed to fool us. And that right there is the billion-dollar question, isn't it? That's the entire core of our analysis today. Is this profit growth just a phantom, something created by clever accountants moving numbers around a spreadsheet? Because that's financial engineering. It's a short-term trick that, more often than not, hides some serious long-term decay. Or did SBC Medical actually do the hard work? Did they shed dead weight, strengthen their operational core, and actually build a more efficient, more profitable machine from the ground up? That would mean a stronger core, a sign of real sustainable value. See, one of these paths leads to a potential trap for your portfolio, while the other leads to a powerful opportunity. We're here to find out exactly which path this is. All right, to get to the truth, we need a blueprint. We need a systematic approach to break this company down to its studs and see what it's really made of. First, we're going to tackle that confusing headline head-on. Second, we'll examine those cracks in the top-line revenue. Third, we'll dig in and figure out how on earth they forged a profit out of that decline. Fourth, and listen, this is absolutely crucial, we are going to check the foundation's strength by looking at the core operations. Fifth, we'll stress test that balance sheet to see if it holds up. And finally, after all that, we will deliver the iron verdict. Let's dive into this.
Okay, Section 1, the confusing headline. You know, if there's one thing the market hates, it's uncertainty. And this earnings report is the dictionary definition of it. You've got two completely different stories being told by the numbers right here. The bear story is one of decline, of weakness, of a business shrinking. The bull story, on the other hand, is about profitability and strength. They can't both be the real narrative that's going to drive the future value of this company. So our job is to slice through the noise and figure out which one is the real signal.
Let's start with the ugly part first. I mean, just look at this chart. There is no way to spin this number to make it look good. Full year 2025 revenue came in at $173.6 million. Now compare that to over $205 million the year before. That's a drop of nearly $32 million in sales. In any business, in any industry, that is a serious hit. It's not a rounding error. It's a fundamental signal that something significant has changed in their business. So before we go any further, we have to understand exactly what caused this gaping hole in their top line. Which brings us right to our second section, digging into those top line cracks. A 15% revenue drop can be a death knell. It can signal a company in terminal decline, customers are fleeing, competition is ruthless, maybe the business model is just broken. So is that what's happening here? Is this business crumbling from the top down, or is there another, more strategic explanation for this massive shortfall? Let's see what management has to say for themselves. Okay, so here it is. The official story, straight from the top, the chairman and CEO, Yoshiyuki Ayagawa. He says this was a business in transition. He's claiming the revenue drop was caused by two specific, deliberate steps. First, a business restructuring they did back in 2024. And second, a major revision of their franchise fee arrangements. He is essentially looking investors in the eye and saying, we did this on purpose. We took a painful step back so we could build a stronger foundation for the future. It's a bold claim, for sure. He's asking the market to trust that this pain is temporary and, more importantly, strategic.
Oh, come on. Business in transition? That is textbook CEO speak for our sales are tanking and we don't want to admit it. I've heard this 1,000 times over the years. It's the go-to excuse when you can't come out and say that your customers are leaving or that the competition is absolutely eating your lunch. So now, I'm not buying it yet, not even close. They need to show us cold, hard proof that this was a deliberate strategic choice and not just a pretty way to spin a really bad number. The burden of proof is 100% on them. Words are cheap. We need to see the data.
That's a completely fair challenge. And, the first piece of evidence management would point to is on the other side of that income statement. So let's pivot to Section 3 and try to tackle this profitability puzzle. Because think about it. If the business was truly weakening, if customers were really fleeing, like you said, you'd expect profits to fall even faster than revenue. That's because of operating leverage working in reverse. But that's not what happened here. Not at all. They somehow managed to forge a profit increase out of a revenue decline. And look at this. The numbers are crystal clear. Full-year net income attributable to SBC Medical grew from $46.6 million in 2024 to $51 million in 2025. That's a solid 9% increase. This right here is the heart of the contradiction we've been talking about. The company got smaller on the top line, but somehow became more profitable on the bottom line. So where did this extra profit come from? Did they just magically become massively more efficient overnight? Let's peel back the next layer of this onion.
And here is the answer. The profit jump wasn't magic. It wasn't operational genius. It was just subtraction. See, in 2024, the company's results were weighed down by over $28 million in one-off expenses. You had $13 million in stock-based compensation that was related to their IPO, and you had another $15.1 million from something called an impairment loss, which is basically just writing down the value of an asset that's no longer worth what you thought. In 2025, those costs simply vanished. They didn't recur. So the profit didn't really grow because the core business was firing on all cylinders. It grew because these massive one-time weights were lifted off its shoulders.
Exactly. So when they go around boasting that their net income margin expanded from 23% all the way to 29%, we have to be really clear about what that actually means. It is not necessarily a sign of superior operational execution. Not at all. It's the direct result of having an incredibly easy comparison to the prior year. This isn't real sustainable improvement. It's an accounting benefit. It tells us absolutely nothing about the underlying health of the business. You cannot build a long-term investment case on a one-time cost just disappearing. This is a classic trap for investors who only read headlines.
I completely agree with you. The income statement is a mess. It's telling two different stories, and the profit story is built on this shaky premise of easy comps. So, to find the real truth, we have to get away from the accounting shenanigans and look at the physical reality of the business. This brings us to what I think is the most important part of our analysis, checking the foundation's strength by looking at core operational metrics. Are more people actually walking into their clinics? Are they spending more money when they're there? Let's find out.
All right, first things first, let's look at their physical footprint. As of the end of 2025, SBC had 283 franchise locations. Now that's an increase of 34 locations from the year before. A company that is truly struggling, a company that's in decline, doesn't typically go out and open 36 new locations. That costs real money and takes real effort. This is the first piece of hard evidence that suggests that beneath all that revenue noise, there's real underlying expansion happening on the ground. This points to demand, not decay.
And it's not just empty clinics they're opening. They served 6.6 million customers over the last 12 months. That's a 12% year-over-year increase in customer visits. Now, stop and think about this for a second. Their total revenue went down 15%, but the number of people they served went up 12%. This directly supports management's story. It strongly suggests the revenue drop wasn't because of a customer exodus, but because of that strategic change in their fee structure and business model, just like they claimed. More people are coming through the doors, even if the old revenue model isn't capturing that value in the same way. This right here might be the most critical number in the entire report. In the fourth quarter, the average revenue per customer recovered to $316. That is an 11% increase year over year. The CEO called this a meaningful inflection, and you know what? He's right. It shows that their new pricing and customer engagement strategies might actually be working. Not only are more people coming in, but they are also starting to spend more money per visit. That is a powerful combination that points to real underlying business health. This isn't an accounting trick. This is a core business metric showing strength. All right, you know what? I have to concede this. A growing physical footprint, more customer visits, higher spending per visit, and you're telling me a 72% repeat customer rate? That
That is a solid operational foundation. You can't fake those numbers. It really does look like the core business, the actual service they provide in their clinics, is strong and getting stronger. But a strong operation needs an equally strong financial structure to support it. So the question now is, what does their balance sheet look like? Can it actually support this growth, or is the whole thing a house of cards? An excellent question. And that leads us directly to Section 5, the balance sheet. This is the ultimate test of a company's durability. A company can fudge an income statement for a quarter or two, but it is much, much harder to hide weakness on the balance sheet over the long term. So, let's see if SBC has built a financial fortress that's capable of weathering storms and funding future growth, or if it's actually just sitting on a dangerous pile of debt. The very first thing that jumps off the page is the cash. The company ended the year with $163.8 million in cash and cash equivalents sitting in the bank. For a company of this size, that is a massive war chest. This cash provides a huge buffer against any market weakness. It minimizes risk, and it gives them a ton of firepower to invest in their growth initiatives, whether that means opening more clinics, making strategic acquisitions, or even expanding internationally. This is a major pillar of strength. Hold on a minute. A fortress needs more than just a pile of gold in the treasury. It needs strong, thick walls. Let's look at the other side of that balance sheet. Total assets grew 43%, which looks impressive, I'll give you that. But look at total liabilities. They jumped from $71.1 million to $117.1 million. That is a staggering 65% increase in a single year. While stockholders' equity did grow, that explosive growth in liabilities is a major red flag for me. Is this fortress being built on a foundation of debt? And you've just hit on the final, crucial point of tension in this whole story. We've got a company with falling revenue but rising profits that came from one-off accounting items. We've got strong operational growth on the ground, but a balance sheet that is taking on more and more leverage. It's time to put all of these conflicting pieces together on the scales and deliver our final verdict. Is SBC Medical a hidden opportunity, or is it a well-disguised trap?
So let's lay this out as clearly as possible. The bull case is this. The hard part is over. The painful restructuring is complete. The key operational metrics, locations, customers, spending per customer are all pointing up. Plus, they have that massive cash pile to fund growth, and management is confident they're poised to return to sustainable top-line growth. But the bear case is just as compelling. Revenue is still technically in a downtrend. That 9% profit jump we saw was an illusion, an echo caused by disappearing one-time costs, not a real operational improvement. And perhaps most importantly, liabilities are rising at an alarming rate, adding significant risk to the entire equation.
So what does Wall Street think is going to happen next? Well, analyst estimates for the upcoming full year 2026 are very telling. They project revenue to rebound to around $191 million, which would be about 10% growth. This shows that they believe management's story, that the restructuring headwinds are finally over. But, and this is a big but, look at the earnings per share estimate, 50 cents, which is basically flat compared to 2025. What does that tell us? It tells us that analysts expect the company to invest heavily in its growth, and those costs are likely going to eat up any profit from the renewed sales growth. The heavy lifting, the really expensive part, is just beginning. So here it is, the iron verdict. SBC Medical has done the hard, painful work of tearing down a weaker business model. That revenue drop was the necessary cost of that demolition. And the profit jump? That was just an accounting echo. What's real, what's tangible, is the new foundation: more clinics, more customers, and higher spending. They have successfully forged a solid operational core, and they have a war chest of cash to build on it. The big question now is the blueprint for the future. The rising liabilities and the flat earnings forecast tell us that building the next phase of their empire is going to be expensive, and it definitely carries risk. So is it a trap or an opportunity? For the impatient investor looking for a quick win, it's a trap. The real payoff isn't coming next quarter. But for the long-term investor who sees the strength of this new foundation, this could be the ground floor of a much stronger company down the road. The right choice really depends on your time horizon. That's our analysis. This is Iron Financial, helping you forge a stronger portfolio.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.